Hey folks, Dave Nadig, financial futurist here at VettaFi. Quick video I recorded up at Camp Kotok with Jim Bianco at Bianco Research and Jeremy Schwartz at WisdomTree, talking about the bank walk phenomenon, the fact that US banks really haven't raised deposit rates the way we've seen around the rest of the world. We talk about some of the responses to that, whether it's what's going to happen with interest rates, how money's moving around in the system. We talk about tokenized banking and some of the work WisdomTree is doing there. And Jim Bianco gives us a little preview on what he sees for interest rates over the next year. Hope you enjoy it. Cheers. Let's talk about banks. It's been a big issue here. We're towards the end of the rate cycle. We know that there's this giant gap between what people earn from their banks and what the rates currently are. Is this something we should be worried about? Did all this get settled in Silicon Valley Bank and we don't have to worry about this anymore? Or are we going to start seeing people move money all over the place?
This issue of the banks not paying appropriate interest rates, I do feel like is an issue. Like we've quieted down on the fears of the Silicon Valley Bank run, but now like, are the banks really paying you the right interest rate when you get over 5% in treasuries and you're going to be getting more as they keep going higher? You know, so the fears have died down. I'm not sure the thing is completely over. And we can talk about the issues. Jim, I'm sure you have a view of the underlying balance sheets. Will there be any issues with real estate or other things? But I don't think it's fully over.
I'd agree with that. A quick definitional thing. We all are comfortable with the word bank run. The bank walk is just a slower version of that.
Right.
Slow enough that it doesn't necessarily imperil the banks that this will lead to a failure in another rerun of March. If it does, it's most likely because there's some malfeasance at some particular bank. We got 4,200 of them, so it's
somebody's doing something wrong,
right?
Yeah.
But it's not necessarily a systemic thing within the system. But as Jeremy said, it is about the interest rate differential between what banks are paying, according to bankrate.com, the average deposit rate, and what varies widely, but the average one is about 50 basis points, about 0.5%, and 5% plus is what you can get in a money market fund. Now throw into that one other thing into the mix. Post-crisis, banks have really pushed mobile banking apps. There is 120 million people that use a mobile banking app at least once a month. Now, pre-crisis, if you were getting 50 basis points at the bank and 5% in a money market fund, it was difficult. You had to go to the bank. You had to fill out paperwork. As I like to say, you had to take time off of work, go to the bank, fill out paperwork, be told a week later the paperwork was wrong, go to the bank,
go back in,
fill it out again, wait a week until the money transferred. Nobody did it.
Right. In the middle of all that, you're worried about your money.
Right.
Which nobody wants to feel worried about their money.
But now you just pull your phone out of your pocket and you move your money. So we've changed the very definition of deposit taking for a financial institution. That money is leaving banks and going to money market funds, treasury bills, and WisdomTree floating rate ETF, anything that will give you a higher yield. This is not, like I said, impairing the solvency of banks, but it is squeezing the profitability of banks.
So let's talk about what the problem could be. I mean, is the nightmare scenario, which won't happen, but like to reduce the argument to the absurd, is the nightmare scenario that literally everybody's got a big cash balance, wakes up and says, well, I don't really use a bank for banking services. I use it to park money in. I'm just going to go park that into a money market fund. And now banks don't have any capital, so they can't lend. So the entire economy collapses because there's no lending market. I mean, is that the true nightmare scenario? I know we won't get there.
Yes, and we are somewhat there. And what I mean by that is if you look at last week, the senior loan officer's opinion survey came out, and it does show a tightening of bank credit standards to the level that if you historically looked at where the bank standards are today, this is where we are in a recession. Not that it's predicting a recession. We're supposed to be in one now. Obviously, we are not. And the reason that I think the banks are tightening those standards is money is leaving. Deposits aren't growing. Loan to deposits is a ratio they have to manage. And if deposits aren't growing, they have to pull back on their standards.
But that's a measurable thing. Is it noticeable? Like, I mean, are we looking at the bank studies and saying, oh gosh, all this money is moving out? I mean, we would be able to notice this, right?
Yeah, I think so. And I would say yes, and we are starting to notice it in companies. The further away you get from big cap mega tech companies that don't need banking services,
right,
to companies like, say, the Russell Microcap, which is the bottom 1,000 of the Russell 2000 stocks. You know, those stocks were still down in the year as late as early July. And a lot of those stocks that rely on banks for banking services and for loans, I think they're feeling it. They're feeling it in that it's getting harder to get credit, not it's imperiling the economy. But this is where the bank walk is shaping up. Now, the fix, just real quick, for a bank is raise your deposit rates.
Right.
But if you raise your deposit rates,
your business looks worse.
Yeah, you're cutting in on your profitability. Your money is more expensive. And so that's why I said the risk here is bank profitability, not bank solvency, and that explains why the bank stocks have been lagging a little bit, because it's more about a profitability worry than an absolute solvency worry.
When their net interest margin isn't going to pay for their full deposits, and they really can't do it. And so, you know, you go think about, I was looking at one of these banks in their investor relations deck, and page one from pre-Silicon Valley Bank, page one of the deck was essentially a statement of, we have the second lowest funding rate in the industry. And then you go to the slide, just because essentially they were saying our customers are dumb and don't care about earning interest on their cash.
Right.
So we don't pay them anything. And it's like, really? Is that what you think? Until a regime change happens where it becomes much easier. The technology is going to make this much, much tougher on them. Like, there's going to be more services that offer checking and bill pay on top of treasuries. And that, to me, I think the banks don't fully comprehend what more is coming.
Well, I mean, is it just a matter of redefining what we mean by a bank? Because, I mean, Schwab's been in the banking business forever. Goldman's, I mean, this
Yes.
is well-trod territory, right? I mean, we first started with the omnibus accounts back in the 80s, right? When brokerage accounts started actually doing real cash management. But like WisdomTree's entering this market. I mean, aren't you guys effectively launching an online bank yourself?
See, there is elements of, if you have Schwab and Fidelity, you have a lot of it in the money market where you could write checks from. Okay,
Right.
that is one element of where there's some of that's out there, but there's still trillions in deposits that are earning zero. And so this bank rate, I agree. You know, we did launch WisdomTree Prime, brand new app. It's working. We've got over 10 different exposures in there. Emphasize on the treasury curve, from floating rate treasuries to short-term treasuries to TIPS funds, long duration treasuries, but very fixed income heavy, with the idea that we're going to be adding bill pay, a debit card that you can spend
At
from.
which point, why is that not just a bank? As far as a consumer is concerned, is there anything I'm not getting from either your services or plenty of competitors doing that too?
No, you don't need the FDIC insurance, because you're going to have treasuries backing your assets that you could then
That are in
spend
40 Act
from.
funds, right?
Right.
So
It's a different model. You wouldn't call it a bank. We might think of it as modern banking services, because it'll have the spending type functionality, but in funds that are treasury funds.
Is there any world in which there's pushback here? Because like when you teach kids about banking, right, you use the example of, well, you give your deposit to the bank and they go and they loan money to the guy down the street to buy a house, and it all sounds very Pollyanna and clever and community oriented. But I think the reality is virtually no mortgages are issued by people's home banks to their communities. Everybody goes to a mortgage broker who ends up sourcing that loan from somewhere else. So how do banks possibly respond when community banking was already on the skids?
I think where they respond is the one thing that they still have, and that's the lending capacity.
But that's my point. If community banking is effectively gone anyway, and it's now just money center banks and mortgage brokers.
For the retail investor,
Yeah.
but for businesses, there's still working capital loans and there's still expansion
And
loans.
funding your inventory, and no, I get that.
And
So
there's
just a commercial thing.
There's going to be that type of lending as well. And keep in mind a quick nice word about the banking system. When the whole Silicon Valley thing came apart, people said, why don't we have 4 banks like they do in Canada or Europe with 5,000 branches? I actually think our system with 4,200 banks is a better system, because big banks service big companies, regional banks service medium-sized companies, smaller banks service smaller companies. Those banks are closer to those companies. And I think small companies, if you said, oh, don't worry, and if you're in Topeka, Kansas, you could talk to the Topeka, Kansas branch of JP Morgan Chase, I think they prefer a community bank that would be a little bit closer to them as well.
But let me push back on that, because in Canada, 6 banks up there, they pay 5% on their deposits because they have to, because when rates changed, everybody knows exactly who they would go to, right? Because if they bank at BMO, they can go to CIBC and they can see on the door, walking down Bay Street, which one's offering a higher rate in Toronto. So if that oligopoly up there is actually creating a much better environment for the average consumer who's got a deposit there.
So let me ask the bigger question: what is the purpose of a bank? And for my purposes, there's two definitions. Is it a warehouse of money? Is it, it's better than keeping it in a box under your bed.
Right.
If that's what a bank is, then you've got money market funds, you've got short-term ETFs, you've got treasury bills, you've got other options to warehouse your money other than under your bed. But if a bank is also a service provider to businesses, whether it's check cashing or money transfers or lending, then what we've got with the banking system right now makes a little bit more sense. And I think that's where the banks are trying to default back to, is that we provide, we pick up the money from the local dry cleaner that, gets paid in cash. And we provide services and we provide loans to businesses. And that's what they're trying to kind of default to. Now, of course, they also provide loans to another type of business, and that would be a commercial real estate lender making office buildings. And
that has its own problems.
Right, exactly.
So Jeremy, then from your perspective, you launched WisdomTree Prime. Do you see that more as a commercial or as a retail offer? I assumed that was like, oh, that's retail. But what I'm gathering is you may be thinking about this more as a corporate cash management type solution too.
We're within a few weeks of the launch, so it's hard to see exactly where it goes. But what I'm pushing our product teams is, and because the Fed is talking about this higher for longer narrative, we have some runway. I was worried, hey, the Fed's going to be doing things. I saw inflation coming down. Maybe they'd be cutting rates and we'll miss the opportunity.
You're going to miss your window, yeah.
But I think it's going to be here with us for some time. We probably have 12 months with rates staying where or high. And so the question, there's no reason why we can't offer this to institutional services. It's obviously going to retail, but why can't we have a corporate checking solution for people?
Right.
And so I think we'll find different ways. We see a lot of business development opportunities for making our funds and tokens. And right now, we're one of the few people who has regulations to trade our tokens. We'd like them to trade in the whole DeFi ecosystem. We'd like them to leave our wallet. Our gold token can leave the wallet because it's not a fund. It's a gold commodity that can go around the world. And so some of these tokens will absolutely live outside of our wallet and be funds and tokens that people can use, but they're going to have to get regulated like we are.
Yeah. And the regulatory environment's got to do a few things there first.
So can I just add on? I think that bankers, when the bank walk happened, their hope was, the Fed's going to stop. They're going to cut rates, and then those money market rates will come back to us. And like Jeremy was saying, I think now they're starting to realize, no, they're not. And it's going to be a while before they come back to us. And they're now starting to think harder about what it means to offer financial services to both retail and commercial businesses, and how they're going to compete in this environment with much higher market-based rates.
I'm guessing neither one of you think there's any chance of a rate cut between now and the election.
I'll say that historically, the last 3 rate cut cycles that the Fed did was 2020, 2008, and 2000. And what was common with all of those? The Fed looked at the economy. We all remember 2020, in March of 2020 when they started cutting rates, and freaked out that we're going down. We're going down hard. We're going into a recession. We got to stop it. We got to cut rates. They don't declare victory and start cutting rates. They did that in 98, and they did that in 95. In 95, when they declared victory on vanquishing inflation and cut rates without a crisis, S&P up 40% in the next year, and Greenspan started talking about irrational exuberance. Right. In 98, after long-term capital, they started cutting rates. The NASDAQ up 85%. There are enough people at the Fed that say, look, we declare victory, we cut rates. Do you want to see 5,700 on the S&P and be talking about bubble 2.0? Another bubble. So they wait, and that's why I like to say, historically, at least the last 3 cycles, the worst time to own equities is when they're cutting rates. Now, remember, they're not cutting rates. Right. They're not cutting rates right now because that's when they're panicking. Right. Things are falling apart. I'll stick with that for now, that the next rate cut comes when things are falling apart and they're chasing to try and stop it.